Mike Larson here with an important bulletin on a sector of the market that I follow closely, banking. Several weeks ago, regulators in Europe swore on a stack of Bibles that the banking sector over there was fine. They cited their much ballyhooed stress tests, which showed that only 7 out of 91 banks flunked. And they claimed that those banks only needed a combined 3.5 billion euros of additional capital. Now, I said from the outset those tests were as phony as a €3 bill, just like the tests were that Washington did here. And the Wall Street Journal concurred earlier this week, reporting that many banks underreported their exposure to higher-risk sovereign debt. Well, in the middle of the day yesterday, news broke that the biggest bank in Germany, Deutsche Bank, was considering a massive capital raise. Specifically, DB is considering selling a whopping 9 billion euros, or more than 11 billion US dollars in shares. Folks, that's more than double the amount the entire European banking sector was supposed to need, according to those unstressful stress tests. And within seconds, the bank's US-traded shares tanked. But it's not just Deutsche Bank that's in trouble. A German banking association just estimated the industry in that country alone needs a massive 105 billion euros in additional capital to provide an increased cushion against credit risk and loan losses. And you can add tens of billions of euros more for shaky banks in France, in Spain, in Ireland, and more. Now, so far, this news hasn't hammered the major US banks. That's because investors are assuming these sovereign debt problems are going to remain bottled up in Europe, or that they're contained. But that short-sighted kind of thinking didn't work in the mortgage meltdown, and it won't work this time around either. My take? US banks are going to be saddled with losses on sovereign bonds just like their European counterparts. And those losses are going to be magnified by ongoing losses on home mortgages, on credit cards, on auto loans, and commercial real estate loans. So if you haven't already dumped any bank stocks you own, do so now. If you haven't already used Weiss ratings to check the safety of your bank, do so now. And if you're ready to go a step further, educate yourself about specific investments that climb in value when sectors of the market like banks fall. To get started, I suggest you stay tuned after this video ends. You'll automatically be taken to a free report I've published, which contains valuable information on the double-dip recession and the risk to sectors like banking. And if you aren't directed there immediately for whatever reason, all you need to do is click on the link below. Best wishes.